Wall Street Week with Louis Rukeyser is made possible by the Corporation for Public Broadcasting and by the annual financial support from viewers like you. By the Travelers Insurance Companies, over 30 million Americans benefit from our insurance, financial services, and managed health care. The Travelers Insurance Companies. By MFS helping mutual fund and institutional investors achieve their financial goals since 1924. And by Prudential Securities. With more than 5,600 financial advisors nationwide, Prudential Securities can help you invest your money wisely. Produced Friday, April 8. Tonight's special guests are Peter Lynch, trustee, Fidelity Management and Research Company, and John M. Templeton, founder, the Templeton Funds.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, this was the week when the financial markets demonstrated one of the great truths of clinical psychiatry. Even a certifiable hysteric has to take an occasional rest. Just when every perennially wrong, perennial pessimist had emerged scarily from the woodwork to assure us that nothing good was ever going to happen again, at least until the 23rd century, the panic subsided and both the stock and the bond markets actually finished the week with gains. Not very robust or convincing gains, to be sure. The markets were faltering again at week's end as jitters resumed about reports coming next week on both producer and consumer prices, and the fear that any mild whiff of inflation would push the Federal Reserve into its third interest rate rise of the tough new year. And as if that weren't enough, still another Japanese prime minister resigned in disgrace, adding to tensions about deadlocked trade talks between our nations. Two Fed governors delivered the presumably startling news that the economy was better than it had been. And anonymous sources claimed that Fed Chairman Alan Greenspan was losing his grip on policy anyhow. As you might reasonably conclude, it doesn't take much to frighten an institutional trader these days. And the combination of rising interest rates and the notorious computer selling, at least 4 rounds of which were tracked on Friday alone, made it difficult for the markets to get out of their own ham-handed way, even if there had been an actual human being on the job. Still, the markets performed notably better than had been predicted by any number of knee-jerk Cassandras over the weekend, particularly after they learned the absolutely devastating news that more Americans were beginning to find jobs, if you can imagine anything as awful as that. Despite learned forecasts spread in less skeptical precincts than this one, that the Dow would be plummeting by hundreds of points this week, it just dipped briefly below 3,600 for the first time since November, and then managed to finish at a level higher than it had ever attained before last October. In fact, as of now, the sober reality is that the market seems to be undergoing a perfectly normal correction, more than overdue, since stocks had gone virtually straight up for nearly 3.5 years, and that the rash of news magazine covers and television fascination with the doomsday crowd was merely providing its traditional function of signaling that most of the bad news was probably already behind us. But as the bears gather their strength to try 1 or 2 more thrusts to the downside, it seemed appropriate to look beyond this essentially futile day-to-day speculation and talk with 2 of the all-time greats in what it really takes, not to be a passing sensation, but truly to make money, big money, enduring money in investing. And here for this special and preternaturally well-timed program are the 2 greatest mutual fund figures of this century, John Templeton and Peter Lynch. In short, something to remember, a program, not a program trade. But first, let's see what happened just when you thought it wasn't safe to go back in the water in Wall Street this week. And as the Dow Jones Industrial Average indicates, tumbling bond prices, sending long-term yields close to 7.5%, and providing what some savvy traders regarded as a rare buying opportunity, scared stocks as the week started. But as rates stabilized, so did equities, and the Dow finished with a gain of more than 38 points at 3674.26, bouncing a bit after a 2-week loss of nearly 260 points. Further adding to doubts about a resurgence of severe inflation was the fact that the only broader index that did not advance this week was the resource-heavy American exchange. One elf bounced too. Gail Dudak, who in a stunningly good call, when the Dow was hundreds of points higher, predicted the decline to 3,600, now says the worst of the correction phase is over and the Dow is likely to hit 4,200 later this year. But the index at a consensus -5 remains in a sell mode. With crises from Africa to Japan, with overblown fears about inflation, and with investors' confidence shaken all over the globe, the flop of the year continued to be gold, which despite all the predictions of a rapid move to $500 an ounce and then much, much higher, is now down to $384, well below where it was when 1994 began. But if 1979 ever comes back, zowie. And speaking of optimistic threads amid the wide despair, Paris and New York designers this week were showing some of the shortest skirts since Eve donned a fig leaf, a traditionally bullish indicator that even if it doesn't pan out, is certain to get considerable attention. Now, before we meet tonight's special guests, let me offer a special thank you to all the viewers who responded to our invitation to submit nominations for the 5th annual installation into the Wall Street Week with Louis Rukeyser Hall of Fame. Tonight, as promised, is the night when we reveal our 1994 inductees. As regular weekly viewers will recall, we began this institution in 1990 by inducting 4 of your all-time favorite guests: Malcolm Forbes, Peter Lynch, Merrill Rukeyser, and John Templeton. And in 1991, they were joined by the first 2 panelists to be selected, Frank Cappiello and Carter Randall. In 1992, the honor roll expanded to include Milton Friedman, Julia Montgomery Walsh, and Marty Zweig. And last year saw the installation of Bob Farrell and Monty Gordon. This year, new nominations have come by the hundreds for more than 50 different viewer favorites, which I suppose is scarcely surprising since we've now been on public television for 24 years, during which time we have had, would you believe it, precisely 817 different guests. The judges, after considering all your nominees, some of whom, while not picked this year, may well earn that honor in years to come, have decided that 2 choices stand out for induction in 1994. These men personify a tradition in which this program pioneered in your behalf. Until we went on the air in 1970, specific investment advice from the leading experts in the business, of the kind that formerly was available, if at all, only to those with large financial resources, was unheard of in the mass market. Not only was it unprecedented, it was actively discouraged. As far as the so-called best people were concerned, it simply wasn't done. What? Tell the hoi polloi the same thing we're telling our top clients? Fie. In fact, some of the great financial institutions of Wall Street actually had rules forbidding the naming of individual stocks by analysts appearing on radio and television. This program changed all that as the champion of the small investor, and the men we honor tonight are 2 outstanding examples of how the job of an industry analyst on this program should be done. The first is Charles T. Maxwell, the preeminent energy analyst of the past quarter century, who regularly kept our viewers well ahead of the curve in a series of memorable appearances, including this one back in 1973.
Charlie, how serious is the energy crisis?
Lou, it's large. It's going to be with us for a long time. It's going to be a fact of life which we have never experienced before, which is going to change our way of life and the future of our industrial society.
Our clothing and hairstyles had changed a bit by the time Wolfgang Demisch arrived, but he showed the same brilliant ability to make accurate and specific predictions.
Wolfgang Demisch, who has just been made a vice president of Morgan Stanley, is making his 4th appearance in 4 years on this program, which shows what we think of his consistently highly rated analyses of aerospace and defense stocks. On his last appearance as my guest in May 1980, I asked him what further events might be anticipated on the international security scene, and he replied, and I quote, "Well, God only knows, Iran invading Iraq, Libya trying to bump off President Sadat, various things which affect our interests fairly directly." Wolf, that kind of precision in public forecasting is rare anywhere on any subject. What does your crystal ball tell you now about the international scene?
Well, I'm hopeful peace will break out as we proceed during the course of the year.
Demisch was a little early, but remember, you heard it here first. So as these two splendid examples of top-flight industry analysts receive their well-earned honors, here they all are. Malcolm Forbes, Peter Lynch, Merrill Rukeyser, John Templeton, Frank Cappiello, Carter Randall, Milton Friedman, Julia Montgomery Walsh, Martin Zweig, Robert Farrell, Monty Gordon, and the two newest inductees into the Wall Street Week with Louis Rukeyser Hall of Fame, Wolfgang Demisch and Charles T. Maxwell. Quite a pantheon. And speaking of superstars, with me tonight are two of the charter members of our Hall of Fame. John Templeton, the Dean of Global Investing, tonight sets still another record by making an unprecedented 13th appearance as my guest on this program. In October 1992, he sold all his companies to Franklin Resources for close to $1 billion. After 54 stellar years in the investment community, Mr. Templeton, or Sir John as he is known at his home in the Bahamas, now devotes his time to 30 church and charity organizations. Peter Lynch, the most successful mutual fund manager of all time, tonight makes his 8th appearance on this program and his 3rd since ostensibly retiring in June 1990. Mr. Lynch, however, is still very much a part of the financial world, both on behalf of his charitable organizations and as a member of the Fidelity Group's Board of Trustees. Gentlemen, let me start by asking each of you, what is the correct message that investors should draw from the recent tumult in the financial markets? John, you want to start?
Markets have always been volatile in almost every nation. The remarkable thing is that over 3 years went by in which the American market had no fluctuation of 10%. So we're back to normal now.
Would you agree with that, Peter?
Well, actually, I think it's 12 years in a row the market had gone up through 93. So we obviously need a pause to get back to normal levels, and I think we've done some of that already.
Is it a bear market, and do you care?
I actually couldn't find many good stocks in January. I started to salivate the last week with all these stocks coming down. If we get a real bear market, I'll have to get out my drill bucket to catch my excitement.
John, you're always after bargains, too. Do you see bargains yet?
Not a lot, but there are always many good bargains. For example, the drug stocks now are thoroughly depressed. The great growth companies will double their earnings in the next 5 years. They're selling for only 12, 13, 14 times earnings, paying higher dividends than the average market, like Merck or Bristol-Myers Squibb or Johnson & Johnson.
Why do you think those stocks are so depressed? Fear that the Clinton health plan will permanently damage their interests?
That is certainly a major factor, but those companies are worldwide. They're not dependent on one nation.
Where are you looking, Peter?
Actually, Johnson & Johnson, I think, is a great stock. I agree with John. I mean, here's a company that spends $1.2 billion in R&D, and they're now cutting costs, and their stock was 58 2 years ago, and it's now 37, and they're going to raise a dividend in a month and buy in a lot of their stocks. So I think Warner Lambert's attractive, a lot of financial stocks attractive, Fannie Mae, Freddie Mac, Travelers, so there's lots of attractive stocks around.
One stock that you mentioned on this program several times when people thought you were crazy was Chrysler. Now it's been one of the stars of the market. Do you still like the autos?
I think the autos, yeah, I think in baseball analogy, I don't think we're in the 8th or 9th inning. I think we're still in the 3rd, 4th, or 5th inning. I think we're just starting to get to trend line. I think we have several years of good growth, and now these companies have great products, good balance sheets, and they're the lowest cost in the world. So I think it's too, we're going to do well with these stocks, I think, the next couple of years.
John, you sound as if you're not convinced that this market's dirt cheap yet. Is that true?
Yes, that is true. The American market is moderately higher than has been normal throughout the American history. And the same thing is true if you look at all the markets in the world. But as always, there are many bargains if you search for them. Just for example, the bank stocks, there are going to be many more offers to buy out regional and small banks. And you take a spread of those in a fund such as Pilgrim Regional Bank Shares, they're going to have many of their holdings bought out at higher prices. And you can buy the stock at a discount.
Since you mentioned a mutual fund, it seems fair for me to ask both of you. Some of the people who are pessimistic about the markets cite as a reason for their pessimism the tremendous rush of new investors into mutual funds. Is this a concern of you? Let's hear both of you on this. John, you want to start?
But they can't take their money out of Pilgrim because it's a closed-end fund. But yes, the vast amount going into mutual funds is greater than any of us ever expected to happen. But that has been true of the public putting their money into stocks before there were mutual funds. I believe putting it through mutual funds will cause less volatility than in the old days when they put it into individual stocks.
Peter, does it worry you?
Well, actually, you've had a lot of money flow in, and it's gone into 1,200 companies have gone public in the last 2 years. That's $60 billion has gone in. 1,200 companies is a big number. There's only 2,400 companies on the New York Stock Exchange. So this money flowing in has gone into great investments to add to plant, add to equipment, add to research. I think it's a very productive thing for our country.
And even with the rush of interest in mutual funds, if you add the mutual fund assets to the stock assets, it's not as high a percentage of household assets as it was in the 60s.
You're right. And also people have been very conservative. Even the 401k investors have been putting the money into bond funds or asset allocation funds or balance funds. They haven't been putting in the growth, the real speculative funds. There's been people a little crazy at the end of last year on these emerging markets and put some money there, but that was the only speculative binge we've had in the last 12 months.
Well, you touch on an interesting area. John, you have a longer history in global investing than anybody I know. Suddenly, you're in fashion. Suddenly, as of last year, everybody wanted to look at the most obscure places in the world and invest. Was that in itself a signal that the thing had been overdone?
No, it's true that for the first time the American public is waking up. The American public has only about 6% of its total assets outside America, whereas 65% of all the stocks in the world are outside America. So it's only a beginning trend, not the end of a trend. However, I don't think they're too high. The emerging market shares are about in line with American share prices, not higher.
Emerging markets covers a pretty wide range these days. Which are the markets you particularly like?
Well, let's say the ones where you can get bargains or where there's been a lot of pessimism. For example, Indonesia, the market went down 50% and more. Also in Thailand, also in Korea, in Portugal, in Turkey, those markets are way down.
This is an area where virtually all individual investors probably have to do most of their investing through mutual funds, isn't it?
Oh, yes. It'd be hopeless for an individual to know which company to buy in Turkey or Portugal.
Peter, are you looking at the world, or are you still too fascinated by America?
No, there's so many great stocks here. I mean, I stay here. I mean, I do own Body Shop International, which is a British company, and I own British Petroleum, but not very much outside the U.S.
Well, John mentioned financial stocks. I remember when you said on this program once that you owned, was it 35 stocks in Fidelity Magellan that had First in their name?
Yes.
Or maybe it was more than 35.
I think I own 200 companies that are west of the Charles River that were banks. So I think the banking industry is attractive. Right in Boston, I like Shawmut Bank of Boston. I like Pam Rappo in New Jersey. I like D&N Financial out in Michigan. I think there's a lot of these companies that are very cheap, and I think they're definitely going to improve their earnings.
The conventional wisdom, which neither of you has ever been guilty of, is that with interest rates rising, it's too late to buy the financial companies. What's your response to that?
Well, actually, right now the banking system has record equity assets, and they have more investment securities than they have loans. That's the first time since the 1950s. So this is one pillar, one part of the stool that's in great shape. This is very shaky at 1990. I think the media has missed this turnaround in the banking industry. And I've never met a banker yet that wanted a recession. I don't think they like non-performing loans. They like the economy to get better. They're not rooting for this. Adding 450,000 jobs last month is a good thing for everybody.
Let's talk about the economy. John, what do you think of the American economy now?
From a long-range viewpoint, I believe the rate of progress is going to be greater in the next 20 years than any previous 20 years in history, because the two greatest worries of our lifetime have been largely removed. One was the fear of nuclear war. Up until 4 years ago, that was a major factor for everybody. The other one was the fear that the communists were right when they said they were going to dominate the earth. They had captured 23 nations. None had ever become free again up until 4 years ago. Those two great threats had a depressing influence. Now that they're gone, there's going to be more investing across international boundaries, more foreign trade, less money wasted on armaments, more spread of brotherhood and religion. The whole world is coming into a peaceful, glorious, rapidly growing period.
I was appearing on another program yesterday and was regarded as something of a Pollyanna because I rejected the idea that the next generation of Americans will live worse than the present one. I take it you share my untrendy optimism.
I would go as far as to say I believe the standard of living in America will double within 25 years, which is an enormous rate.
What are some of the reasons it will double?
Well, for example, 50% of all the scientists ever lived are alive today. 50% of all the books published were published just in the last 60 years. 50% of all the scientific discoveries ever made were in this century.
Yeah, but the pessimists say that we're threatened by foreign competition, that our educational system is a wreck, that we're going to have too many people in retirement. That doesn't worry you?
Oh, yes, there are plenty of things to worry about. Always have been, always will be plenty of things to worry about for a person, a family, a corporation, a nation. But there are so many good things that are not publicized. For example, the number of people attending universities in America is 10 times as great as it was 100 years ago. The number of people getting doctor's degrees in America now is 10 times as great as it was just 60 years ago. Everywhere you well, let's take agriculture. In 1800, 85% of the people had to live on the farms just to produce enough food. Now, with a little over 3% of Americans on the farms, we worry about surpluses, not shortages of food. This could go on and on.
Peter, I almost hesitate to ask you about the overall economy because you're always kicking the tires in individual companies. Do you make any kind of an overall appraisal?
Well, I think we've had 9 recessions since World War II. We just had number 9. We've had a slow recovery. That's not surprising. We've added 3.4 million jobs off the bottom. We lost 2 million. We've lost 500,000 manufacturing jobs. We've only added back about 10,000. But I'm impressed by our job creation in this country. I mean, the decade of the 80s, we added 18 million jobs, with the 500 largest companies eliminating 3 million. We're going to do that again this decade. Not quite as fast because not many people entering the workforce. So it's quite a machine.
The cynics say, oh, yes, but they're all hamburger flippers at McDonald's. That wasn't accurate, was it?
No, there was 2.1 million businesses started in the 80s. If they just had 10 employees each, that's 21 million jobs. I mean, I think they're wrong. They continue to be wrong. And I think this capitalist trend that we've had that's spreading, productivity is improving. There is a hitch that America used to work right for about 90% of Americans. It's now working maybe for 65. A lot of people in the inner city, a lot of people in the rural country. We need to do this retraining of America. It's very important.
John mentioned a revival of religion. I know that interests you, but it also interests you that you're working in the inner city in Boston. You're very concerned there. Tell us what your ideas are. How are we going to get to those 35%?
Well, you have to stop this high school dropout rate, which is approaching 50% in every major city. There's lots of scholarships available to people if they make it through high school, but they're gone if they drop out in 8th or 9th grade. We have to keep open the branches of the public libraries. Those are very important. Have to do Big Brother, Big Sister. We have to do more of the boys' clubs and girls' clubs. These are wonderful things that keep people interested. They need to just keep away from despair, and we have to get jobs into the inner city. We have to get factories in there.
Returning to this nervous financial market situation, John, are you concerned that inflation is roaring back in America? I know you always keep an eye on it.
Yes, I am. That is one of the many worries if you want to find things to worry about. There will be bear markets. I would say that there's likely to be 2 major bear markets every 12 years in almost every major nation, including America. But on top of that, there is a long-term trend toward inflation. Now, that too will go in cycles. Sometimes there'll be good years with maybe 1% inflation, other times bad years in America with 15% inflation. But if it averages out to 6% a year, that'll double your cost of living every 12 years, and in 40 years it'll cost you 10 times as much to live as now.
Neither you nor Peter spent a lot of time worrying about market forecasts. Does this market, which you said still looked a little rich to you, look like one that can go up over the next couple of years, or don't you worry about that?
It will go up, but I don't know when it will go up. My analysis is that sometime before the end of 2000, there's a better than even chance that Dow will go above 6,000.
And that'll be either good or bad depending on how much inflation we have between now and then.
Yes.
Peter, how does it look to you, this market overall?
Well, I think Johnson & Johnson's going to double their earnings in the next 6 years. I think the stock will double. I mean,
whatever happens to the stock market, whatever happens to the economy.
I think profits will be good the next few years, and I think the stock market will do well. There is a fear that inflation heats up. That's a fear we'll find out in a couple of years.
What would you avoid?
Well, I think the electric utility industry is definitely in for competition. It's not the same industry it was. They're being hurt on all fronts. It's not growing. They can't cut costs. I'd rather own telephone utilities like NYNEX or Southwestern Bell.
Thank you both for some wise words at a moment of high nerves in the market. Thanks, Peter Lynch. Thanks, John Templeton. And I hope you'll continue to join me later this evening. Indeed, coming up next on most of these PBS stations, please check your own local listings for a very special hour that could be of vital importance, not just to you, but to your children and grandchildren, too. It's called There Goes Our Money. And you'll find out at last how the federal government manages to spend $1.5 trillion a year, with much, much more to come. I'll be talking with a variety of Americans, ordinary and extraordinary, from Nobel Prize-winning economist Milton Friedman to President Clinton's budget boss Leon Panetta, about the real reasons this federal spending monster has gotten so out of control and where all that money really goes. And don't tell the politicians, but we'll even have a few thoughts on how you could make it stop. I hope you'll join me, and I hope you'll be back here next week when I'll be taking a night off, but my friend and colleague Mary Farrell will be sitting in for me and talking with a highly successful value fund manager, David Schaefer. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser is a production of Maryland Public Television. Made possible by the Corporation for Public Broadcasting and by the annual financial support from viewers like you, by the Travelers Insurance Companies, providing American business with insurance, financial services, and managed health care. The Travelers Insurance Companies. By MFS. MFS helping mutual fund and institutional investors achieve their financial goals since 1924. And by Prudential Securities. With more than 5,600 financial advisors nationwide, Prudential Securities can help you invest your money wisely. For a printed transcript of this program, send $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. Transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Wall Street Week with Louis Rukeyser is produced by Maryland Public Television, which is solely responsible for its content.
This is PBS.